unless you've been living under a rock, you have seen what's happened in private credit. Like, I think defense tech, aerospace defense tech is a component of a bigger opportunity in VC.
Chris, you're really talking about rebuilding the industrial base in the U.S.
A lot of people are focusing on sexy things, rockets, and all, but there's a ton of opportunity in a lot of the boring things.
Chris, do you know anybody following our advice?
I mean, I think it's starting to happen. Maybe we should do another ham and egg piece.
I'd love it. Against Consensus is a weekly podcast in collaboration with Fin News. In each episode, I interview asset owners, asset managers, allocators, service providers, and innovators who are challenging conventional thinking to create better investment outcomes for their beneficiaries and their clients. Our goal is to elevate the conversation and help you make better, smarter investment decisions, but always with a little edginess along the way. Today, my guest is Chris Schelling. Chris and I have co-authored a few essays over the years, and occasionally we've debated our differing views in public, but every time we talk, I always walk away having learned something. He's a true student of the market who refuses to succumb to the status quo. He's always digging into data to uncover non-obvious insights others miss, and he has a relentless focus on delivering better outcomes for clients and beneficiaries. Most recently, Chris was the managing director of the Pan-Alts team at Aksia, providing customized investment recommendations and value-added research and content across alternative investments with a focus on wealth management. Prior to joining Aksia, Chris was the managing director of private markets at the Caprock Group, where he oversaw $3 billion in assets allocated across private markets. Before that, he held various managerial roles, including chief investment strategist at Venturi Wealth Management. He was the director of private equity at Texas Municipal, and he was the deputy CIO for the Kentucky Retirement System. Previously, Chris was also a monthly columnist at Institutional Investor. He was an adjunct professor at the University of Kentucky, and he's also the author of the book Better Than Alpha: 3 Steps to Capturing Excess Returns in a Changing World. We'll put Chris's bio and links in the show notes. In this episode, we discuss AI adoption and use cases, defense tech as a viable investment opportunity. We discuss the situational awareness situation and the democratization of private markets. As usual with Chris, it's a dog's breakfast of topics, and that's exactly why the conversation always delivers. Enjoy the show. Chris, welcome to the show.
Thanks for having me, Angelo.
My pleasure. I got a few warm-up questions for you. If I remember, you're an Illinois grad, but you also taught at the University of Kentucky.
That's right.
So is it Big Ten football or SEC football?
It's got to be SEC football. Yeah,
Ooh.
It's got to be. It's got to
Okay.
be SEC football. Yeah.
So if you had to pick one for the next decade, would it be the private market illiquidity premium or the public market liquidity premium, I guess, and agility?
See, I don't think that's an easy question to answer. I think the private market illiquidity premium in aggregate is going to decline. And so it's about where you're going to have to pick your spots in private markets to capture that premium. It's all about implementation, less asset allocation.
Okay, I'll take that answer. And finally, Chris, what's one piece of technology you cannot live without?
Well, my phone, I'd have to say. Yeah.
Okay, that's pretty easy.
It's
All right.
easy, but that's the truth.
It is. You know, and I've been doing some reading actually on that phone within a philosophical context. I don't want to go into that, but it takes me back to Hegel, like we were just talking about. Okay, so Chris, let's start off with the topic du jour: artificial intelligence. And you and I wrote a piece for Institutional Investor in 2018, and I think the title was "Why Are Allocators in the Manager's Selection Stone Age?" This was long before LLMs and AI agents. Am I right?
Yeah, right. We look prescient. I'll give you the credit for that, but
That's exactly the word I was going to use. We did look prescient because long before LLMs and AI agents, we talked about having a bot do the interview with a prospective manager.
right.
And how that bot would be able to do a Q&A format and kind of respond to questions. But we also talked about how there was the possibility of using some newer technology in 2018 kind of like, detecting changes in blood flow in someone's face and speech rate and modulation. And I got to say, since 2018, those technologies have really become much more sophisticated. And you're seeing these multimodal, I think they're called effective AI systems used in healthcare, and they're using them in computer vision. And it's like, we're not seeing them in our industry. This is your conclusion, where you talked about how I believe that our fiduciary duty includes the obligation to always try to do better for our beneficiaries. And if tools and technologies exist that can improve the likelihood of successful manager selection, we should collectively as allocators be considering them. And I said, from your mouth to God's ears. But Chris, do you know anybody following our advice?
I think it's starting to happen. Definitely people are using AI agents to review documents and be more efficient in terms of going through prospectuses, going through PPMs, LPAs, et cetera, pulling out information, even credit documents and underwriting co-investments. People are using the tools that are available today. So it's really within the last year where we've seen some of the efficiencies from that start to actually occur. But it's still early days. I think one of the most interesting examples of a fully autonomous agent being used in investing is from a very large blue blood private equity firm. Like, I'll decline to name them publicly, but they have, call it, an 11 or 12 person investment committee. And there is now an agent on the committee that has a vote. And it's fed the deal memo. It's fed all the information around it, has access to the entire firm's network of folders and files, and it comes with questions and viewpoints that human members of the IC maybe would not have thought to ask, or paths to go down that they wouldn't have looked at. And so they found it to be really helpful. I don't think it's I don't think it's changing any of the decisions. It's one vote on a very big IC, but it's just bringing information and a viewpoint to the fore that hadn't been there before. So yeah, there's things out there for sure today that are being used. But I posted on LinkedIn just the other day asking my network, are people actually adopting any of the things that we talked about in that article, and haven't heard too many people actually saying they're using them.
I don't even think people are thinking about using that multimodal, affectation. I think that's still beyond them. But Chris, you raised 2 points. One is you're seeing adoption apart from this one investment committee. We'll get to that in a second. It sounds like it's a lot of operational efficiency.
Correct.
Reading memos, summarizing memos, doing research that is then delivered to a group of humans that'll use that information to make better decisions. Correct?
Correct. It is making people more efficient. It's doing analyst work faster and better.
But are you seeing anybody doing it to generate alpha directly?
So there are, firms that are using it to make decisions. I would say not so much in private markets. It's a different cadence of decision making. So it's a feed or a step in the process. And a lot of people still have sort of human in the loop. I think people are iterating. So I'm an advisor to a credit firm called Hum. They provide capital, mostly credit, but sometimes equity to small and medium-sized businesses, not all technology. So they might lend to a pizza place or a small HVAC. And they've always had sort of human in the loop in underwriting. And now they're starting to iterate parts of the process to be less and less, sort of human in the loop. And so it's interesting. They're taking out like the edge cases where they've seen the superior decision making is, the underwriter may have been friends with the executive and they went to school together. And so this doesn't check all the boxes in the checkbox, but they make an exception. And this time, historically, they've said that's where they get into problems. So they've stopped doing that. And the autonomous system doesn't have those biases. And so they're starting to iterate and get closer and closer to it, but it's still a person that's making the decision. I think it's augmenting human judgment.
Is there accountability in that feedback loop? If the machine is coming up with ideas or decisions, granted, the human makes the decision at the end of the day, but is there accountability or explainability how it got to that idea?
I don't know the answer to that. I would assume yes, just given my knowledge of the company and the executives running it. They sit down and actually assess the two side by side. And so one of the uncomfortable conversations is here's the system, here's the person, and look, it's doing it better and faster than you. And the people are like, oh yeah, that's better than me. So there's definitely that sort of accountability.
Why do you think there's a drag on adoption? I mean, whether it's private or public markets.
In public markets, it's definitely the cadence of decision making, and it's more relational. A lot of it is winning the deal from the portfolio company executive, whether it's as a lender or as an equity investor. They want to get to know their partner, and sometimes it's not purely a price-based decision. It's you can expand their network by bringing in your network of people in their industry or things like that. Value creation sort of post-closing. So I think in private markets, it's still a ways out because, and data is less ubiquitous, right? Like data asymmetry exists. No one owes you information on their privately owned business or owes you information on their portfolio. And so getting the data, scrubbing the data, that's a big part of it. I think it is being adopted in public markets more frequently. People are using the data that's available, and they're using their own systems, building autonomous agents to make decisions. I mean, you're seeing some hedge funds that have, whether they do, whether it's truly AI or not, I think that's another question, but people that are using systems to make decisions.
Yeah. I guess the question is, are they fully autonomous at this point?
Correct.
And what I'm hearing is no.
I'm not aware of too many. I mean, there's a few. I mean, you've spoken to people, and you've had some on your podcast in the past that are doing some things. So there's people picking stocks, there's people making asset allocation decisions autonomously, but it's definitely the edge case.
Yeah. And let's go back to the comment about the IC member, is what I'll call it, having a machine as an IC member. In 2016, I wrote about a firm in Hong Kong that had an AI. It wasn't an agent then because they didn't have LLMs then. We hadn't done the whole transformer thing. But they had an AI system that was a voting member of the IC. And the IC would not invest unless this system said they should invest, which, I don't know if they're still doing it, but I dug back in my notes and I saw it. But I did see recently, and I don't know if you saw this, but Mubadala has come up with this. And they have now built what they're calling what name did they use? I don't remember what it's called. But they Maya, I think it is. And they have their own agent now that sits and reviews with the investment committee. So we're moving this way.
Right. And I think that's a logical next step. I mean, I haven't heard of places where there's a veto vote, basically, which it sounds like that firm had. If it's not a yes from them, it's a no. Like I said, 11 or 12 people having one more member vote. I mean, it's basically for them to think differently, see around corners, bring in information that they might not have been aware of. But you can see it kind of growing and expanding as they get. Part of it, I think, Angelo, just has to do with humans not wanting to give up control of the decision making. Like they just want that final say. I mean, that's what a CIO is built to do. Asset owners are built to think like the buck stops with them. So I think that's a behavioral constraint that's going to take a long time for people to give up completely.
I agree with that. I think there are a number of those constraints that are stopping the adoption, and it'll take some time. We'll see this in a generational shift, I think.
I think it's maybe even longer than generational. I mean, having experienced, boards being hesitant to delegate authority to even human agents because they're the final fiduciary, they have that risk, like taking it one step further and having no human in the loop. I think it's going to take a long time. But using it for efficiencies in the process, similar to what we wrote about, like that's definitely happening.
I don't know. Maybe we should go back and revisit that article, Chris, and see if we could update it.
We should, and update it with newer things that can do more efficiencies. Yeah,
especially with the LLMs. Chris, let's shift gears here and go to defense tech. And I could do this with you because you're a very broad thinker. I mean, you're also deep. But I mean, given your perspectives on the industry over the years, I mean, you've covered publics, privates, I mean, all kinds of different sector exposures. So I'm going to pivot and go to defense tech and look at defense tech as an investment opportunity. What are you seeing there?
So I would zoom out one layer. I think defense tech, aerospace defense tech is a component of a bigger opportunity in VC. And so I sit on the board or the IC for a little VC firm called 1200 VC. We have partners that we invest alongside, one of which is Grant Gregory. at Cantos. So I'm going to give him credit for the thesis, but I think he's spot on. And I've learned a lot from Grant, but he has what he calls American dynamism thesis. And so the U.S. has spent, decades optimizing for, software services, capital efficiency, asset-light businesses. I invested in, a lot of SaaS businesses over the last 10, 15 years, but a lot of our physical productive capacity, whether that's manufacturing, energy, infrastructure, supply chains, again, aerospace defense is a component of that, they have, atrophied and moved offshore. And so this thesis is about using startups to really solve those problems and bringing that capability back in the country, or nearshoring, whatever you want to say. But rather than building, another consumer or enterprise software company, it's doing sort of hard things. And so these are technical, capital-intensive companies that are tackling large physical world problems. So we can talk about aerospace defense. I think manufacturing, critical infrastructure, energy, maritime, robotics, et cetera, like all those things are part of the opportunity set.
So what's the thesis? I mean, you push back, but why should investors be looking at what I'm going to still continue to call defense tech or deep tech?
Yeah, defense tech specifically. So, right, that's like a $3 trillion global market, 2025. It's growing fairly slow over the last decade. Think of it as kind of like GDP or sub-GDP growth. But that's accelerating. And certain segments are growing faster, and that's where there's this opportunity in sort of VC. Last year, it grew, I think, 10%. A big chunk of that came from European military expenditure, which grew 14, 15%, right? NATO members have committed to spending more of their GDP annually going forward. So it's growing faster, and the composition of spend is also changing within aerospace and defense. Things like networks, resilience, innovation saw 20+% growth last year. And so you also have this dynamic where there's these legacy primes that have gotten all of the defense budget in the past. And that's changing. They're down to like 30 or 35% of total addressable market goes to the top 5 legacy prime incumbents, and upstarts like Anduril and et cetera are taking more and more of it. But it's this implementation, this combination of like software with physical real world problems and manufacturing capabilities. Like, to me, really the difference today is this manufacturing capability, and the speed to production, speed to manufacturing is fascinating to watch. A lot of these executives have come from like SpaceX. They built the Raptor engines and scaled that production. That's literally one of the most complex things that it's literally rocket science. And so they're now spinning out and starting all these businesses across really fascinating little things. So again, aerospace and defense is super interesting, but it's a component of this bigger thing where Grant has this, viewpoint because he was at Andreessen Horowitz and he's seen it before. And sort of there was the first, green tech cycle in VC where there were these big capital inefficient businesses that were capital intensive. You had to invest. They took a long time. It was kind of this green tech boom and bust, and it didn't do very well from an investment perspective. And I think there's differences today. They're still looking for businesses that are relatively more capital efficient. And it's really speed to sort of commercialization rather than taking sort of breakthrough technology, moonshot risk. It's more about scaling and commercializing and iterating to get faster and faster, more efficiencies, remove human from the loop.
Chris, you're really talking about rebuilding the industrial base in the U.S.
A lot of it is, but it's improving and iterating on it to build efficiencies in there that weren't there in the past. And I think that's really the cost advantage on a lot of this stuff, or capabilities that weren't there.
I'm sorry, is the improving efficiencies also seen on the procurement side?
I think it can be. I'll give like an interesting example of a company that we did invest to recently. We co-invested, again, alongside Cantos, but called Resurgent Industries, and it's not sexy. We can talk about like the premium for sexy assets as opposed to a discount I think you get for boring assets, but this is a yarn production company, right? And so thinking about like reshoring manufacturing capabilities, a lot of people are focusing on sexy things, rockets, and all, but there's a ton of opportunity in a lot of the boring things. And so yarn, for example, 85% of yarn production occurs in the United States, and it's almost all shipped overseas. It goes through 6 countries on average and travels 10 to 15,000 miles before the finished garment comes back to U.S. consumers. that's a huge percentage of the total unit cost by the time it comes back. And so Resurgent, founded by a guy from SpaceX who was involved in building the Raptor production, is building technology. It's basically autonomous, software-enabled manufacturing capability that takes raw cotton through a complete dark 24/7 manufacturing process, end-to-end, cotton to yarn to textile, and just builds it in-house. And so they've gone from company formation to first yarn run in under 4 months. And so like I said, it's the speed to production, speed to commercialization today that is really a huge edge. But so you take all the humans out, iterate on the process, right? Collapse steps in the workflow and reduce scrap, reduce waste. Like you can get a massive cost advantage and take all of that travel, out of the loop. So things like that. And then there's lumber manufacturing and paper and all sorts of old world things that just don't seem to be technology, but they're investable, in my opinion, right now in VC.
But you're still not dealing with defense there. Yarn is not part of defense. And I will say, in my view, I'll give you my thesis. We saw kind of the universe change with the Russia invasion of Ukraine. And we saw drones being produced locally in Ukraine and taking on Russia. And we still see it today. And I think that got the attention of the U.S., NATO, and maybe even some in Asia, as they saw there was a need to retool the warfighter. It's not all about jets and rockets. It's about artificial intelligence, machine learning. It's about cyber. It's about advanced materials, advanced electronics, quantum. And you're seeing people, in that deep tech, in that defense tech space. And the government has a huge budget right now. We know the defense budget is growing, and I'm not sure if it's $1.5 trillion right now, if they've passed that, but it certainly was the biggest defense budget we've ever had. And the problem is you can't do it all with the defense budget. You need private investors to come in and make the case that there is a need to invest in national security, but there's also an opportunity there. And I'll finish, Chris, by saying that opportunity that I'm seeing is primarily in dual-use technologies. I looked at PitchBook. 70% of the private deals in defense tech are now dual-use, dual revenue streams.
Mm-hmm.
So I think it's that dual-use piece that is attractive.
For sure.
And, I think there's a number of reasons why, because obviously it's a bigger market. You're not just beholden to the government. There's a chance for a quicker exit maybe. But the barrier that I saw with this thesis that, yes, national security, there's good investment opportunities. It could be the industrial base. It could be software. But at the end of the day, a lot of investors push back because of the old model of ESG that, we're talking about military-grade weapons here. And they push back. Any thoughts on the ESG argument?
Well, yeah, I think that has changed a little bit in the last few years. I think there are still people who don't want to invest in pure defense/weapons manufacturers. But your point on dual use, it's depending upon the specific sector, right? The commercial market can be maybe 5-10 times the size of the defense space. And so it's a huge opportunity. But those technologies that you talked about, drones and autonomous technologies for maintenance and security, like they can also be used in, again, maintenance and security for power generation, for critical infrastructure, dams, pipelines. That same drone can go over, miles and miles of pipeline to investigate for leaks, or can keep an eye on a dam or a bridge or something and investigate for failure and do it better, and use AI to actually do a better job predicting where there's potential concerns and points of failure on that infrastructure. And so, yes, that is a more ESG-friendly use case for the same technology. And I think the best companies are pursuing things that have that.
Yeah.
So
I would agree
that is
with
part
you.
of the American dynamism. I think it's all just one thing. You may not want to be involved in the defense sector, and to my example on Resurgent Industries, it's yarn, but he was at SpaceX. And so there's so much crossover with the manufacturing capabilities right now that yes, it's interesting.
Yeah. And I will say, you mentioned in this one example, someone that was former SpaceX. I see a lot of that. And I think that opens up a lot of opportunities. People coming from SpaceX and are all It could be Palantir. I mean, they're coming and they're going into their own portfolio. They're building their own portfolio companies here now.
Right.
They're doing their own startups. And these men and women, they understand the technology. They understand, I believe, the industrial production that's needed. They kind of get it. So it's not I don't want to disparage 25-year-olds, but 25-year-olds that have never built anything. And I think that's attractive from the VC and PE perspective.
100%. The teams today, they have manufacturing chops within the defense sector. A lot of those teams have deep defense procurement experience, networking connections. Some of them, like Saronic is another example. We talk about autonomous vehicles. It's naval vehicles, but that's a frontline operator in defense and someone with experience with the real world user needs and logistics, et cetera. And not just that deep tech manufacturing capability as well. But you combine all those things, you see a lot of people from, like you said, Anduril, SpaceX coming out and putting all those teams together. So it's critical. I would say it's critical to have the right team in place for the technology, the commercialization, the sales from day one. And those firms are, launching day one with the team in place, and that's why they're scaling so rapidly.
I would add they also typically have someone that understands the procurement process.
For sure.
Because while it might be dual use, the government could be a big anchor. I mean, and you're finding the government itself, the DOD is now changing its procurement process, between the Defense Innovation Unit, the Office of Strategic Capital. They're trying to make it more efficient. I'm not sure they have yet, but I think they recognize they need to be able to expedite that decision-making and allocation.
They need to, and I think it's better, but it is still a long and cumbersome process, and it helps to have people who are very experienced at navigating those hallways.
Yeah. And we're kind of seeing the pinch today, given when we're recording this. The U.S. appears to be struggling with its munitions inventory. And building Patriot missiles is not something that one does with an LLM. I mean, it takes months to build these things, if not years.
It's doing hard things. I mean, I like a lot of those opportunities because they're not just, coding some cool software or doing some media things. Like, it's a physical, real world thing that needs to be built. The production capacity behind that needs to be built and scaled and managed. And it takes time. So that's the one thing I would say about a lot of these firms is, yes, they're still fast, but it takes time. These are work, effort, and capital intensive businesses.
And investors have to be aware of that. If I'm going into a VC fund that's committed, I'm going to say defense tech again, I need to be aware that there may not be an exit in 3 years in some of these companies. It's going to take 7 to 10 years.
For sure. Yeah. And I'd say that dynamic is not merely limited to some of the hard tech opportunities. It's what's happening in general. Private equity and venture capital, we're just seeing hold periods extended, DPI lower, and I almost think VC's bifurcating into two separate asset classes: early stage and kind of late stage. They're not the same thing anymore.
I'm thinking the difference with defense tech is it takes a long time to build these and get them into the field. I think what's coming to my mind, Chris, is here we're having a hard time in the private markets in terms of exits. And that just seems to be something that's kind of getting the attention of asset owners, the LPs, more and more. And that's not defense tech. I think you're right. It's across the board.
It's across the board. I would say two themes from allocators and asset owners are AI and lack of DPI. In fact, 2 years ago, Menlo said those were their 5 letters for the next year. Everything's going to be focused on AI and DPI. That's it.
Yep. Well, should we pivot into another topic that you and I had discussed in our pre-call? We want to go into situational awareness. Plenty has been written about this. I mean, I will say, Chris, you and I were there for long-term capital in 1998. We saw Amerant. I think it was 2006, maybe. Both of these firms had their problems because of concentration risk and excess leverage. We're seeing something similar here. I don't have any inside information on this. I read the same stuff you probably read, whether it's the FT, Bloomberg, or some good blogs of critical thinkers. But I mean, you got an individual here that had no investment experience. He wrote a 160 or 70 page piece. Maybe I'm not going to call it a thesis because I don't think it deserves that. But it got the attention of individual investors in Silicon Valley. And with an 8-person team, no experience as a PM, they raised this money, and then they get in a little bit of trouble at the end of the month. Any thoughts on this? I mean, I kind of laid it out for you, but
no, I mean, zero asset management experience, zero asset owner practitioner experience. Certainly was, from what I know, I've never met him, but have talked to some allocators that did, and very thoughtful and knowledgeable investor in terms of AI space and AI opportunity set, but not experience with managing, traded assets. So you mentioned things that were 10, 20 years ago, but even Archegos, that was not that long ago. It's the same story over and over again. It's, you can go back to Reminiscence of a Stock Operator, Jesse Livermore. It's the same thing, that combination of concentration, leverage, and then volatility. Stocks that can go up, 400% in 2 years can certainly drop 25% in a very short period of time. And when you're 4x levered, like I think they were, that wipes out 100% of your equity. So yeah, that's painful. I heard that their biggest position was like 18, 19% just in one component manufacturer. So that's tough when you've got, mark to market leverage. I mean,
absolutely,
that's a strategy that's probably better suited for private markets, where you don't have mark to market leverage and you have a 10-year plus sort of hold period. Your leverage is term, cash flow type leverage. Different outcome would have been probably the case then. But
well, when they sold their public markets exposure to Citadel, they kept their Anthropic. They were early to Anthropic. So it kind of goes back to, if you're going to have that concentration risk, better in private markets. But I mean, to me, getting a position at Anthropic, I'm not sure how much of that is skill versus luck. You know what I mean? It's an allocation.
Yeah, it's hard to argue that's the same skill necessary in early stage VC, where you have to look at a ton of different opportunities when you're, getting a slice of a big winner that's, round D, E, whatever. Like, that's a very different game.
Yeah.
And that's what I mean. Late stage VC is really transitioning into massive rounds and very few winners, concentrated markets. If I look at fundraising just in venture, the last 6 months, just year to date, it's like 20% more than it was for the full year of 2021. And almost all of that is into mega late rounds for AI deals. So like I don't want to say those are definitely going to work out, but those are a de-risked type of opportunity relative to a lot of the early stage sort of VC that people want, 10x outcomes from. You're probably not going to get that from this, but it's a different world today than I think it was. And I think a lot of allocators realize that already. Like, they're thinking of those as very different things.
Yeah. And just going back to situational awareness, I mean, there are still figures that are, calling him the Warren Buffett of Gen Alpha. One guy made a comment, he will remain an important figure in Silicon Valley for a long time. I mean,
Wow.
He could be an important figure for different reasons. You know what I mean? But it looks like there's a schism between how Silicon Valley invests and how Wall Street looks at investments.
Sure. Yeah.
And it's, you've got a popular figure here coming up with this thesis, and, suddenly they think he's able to run money. And the enthusiasm hasn't faded. I mean, people are now allocating to him,
right.
Even more so. And, is it the greater fool theory? I don't know.
I mean, I don't know. Like, more power to him, and, good luck. But yeah, I think that's, from my seat, I see a lot of institutional allocators that are picking spots in AI still, for sure, but they're also increasingly looking through to their entire portfolio to understand sort of the overlap, because you have it in your infrastructure. You got digital infrastructure, you've got private credit. They're lending to those businesses. You've got it in some of your SaaS businesses, in your PE book. You've got a lot of it in your venture, and then even in your public portfolio. I mean,
yeah.
The big seven or whatever, they're 35% of the S&P 500, and so the total exposure is huge. you want to give situational awareness more money now, good luck. But I think a lot of people are trying to be more circumspect about where to put their capital to work.
There's certainly those that are fiduciaries.
Correct.
I'm not sure of his investor base. I don't believe there were a lot of institutions in there. I believe it was a lot of private money. It may come from a family office, but it was private money.
I mean, I've heard of a few institutions that were invested, but I don't know too many like big gatekeepers that had, underwritten him and provided full diligence and said, like I'm aware of one who in particular who said, there's a lot of risk, there's a lot of leverage here. They sort of warned about that. So
yeah,
I don't know if it was a ton of institutional money. That's one of the things that I think has occurred in this venture cycle has been the growth of the individual investor in retail, putting capital to work in a lot of those late stage deals. I call them sort of SPV jockeys, where you've seen really they function like brokers, people selling exposure to Anduril, selling exposure to SpaceX to a lot of individual investors and wealth advisors. And sometimes it's not even direct exposure to the stock. It's itself another SPV that owns something underneath it. And so there are these, SPV sandwiches that they're out there with fees upon fees upon fees. But there's so much demand for those sexy assets, right? Everybody wanted SpaceX. Everybody wants Anduril, that a lot of wealth capital has flowed into it as well.
We'll go to retail in a minute. One final thought on situational awareness. If I'm an institutional investor and I'm doing diligence, and I discovered that Barclays decided not to take them on as a prime client, that's a red flag to me. I mean, because, Barclays is certainly up there with the other big primes. And I'm thinking this is just a lot of money that flowed in from individuals that had a lot of money to play with, and they loved the thesis, and they couldn't find an ETF to do it.
Correct.
So,
it's the thesis. It's a thesis play. It's 4x levered beta bet. I don't know too much institutional capital that would have been comfortable with that, just as the thesis, and with an experienced portfolio manager. I mean, he didn't have, somebody from Viking that joined him to help manage the portfolio. Like, he didn't have that sort of institutional chops. And so I think you're probably right.
Let's go into this. You've mentioned, this, I think you call them SPV jockeys. I like that term, Chris. That's pretty cool. That would be a great title for an article for you, man.
There you go.
But, it kind of gets us to the final topic, this democratization of private markets that we're seeing right now. And in this case, you're talking about SPV jockeys. It's accessed maybe through a derivative. I don't mean a derivative like an option, but a derivative structure that they're getting access to a private investment. I mean, it shows the overall demand in some cases, but I don't know how great that demand is.
Oh, it's a good question. And I think I sort of view it as this spectrum of democratization versus productization. And so, maybe you make productization to be Wall Street's going to sell whatever they can sell. Well, absolutely they will. And democratization, I wouldn't hold it out as this idealistic, make everything accessible. There's a little bit of both involved in it. But it definitely, there's different quality of product coming to market because there is a big opportunity there and there is demand. So I know, like big numbers, Angelo, you're talking about $100 trillion market that's got a 2% allocation to privates. Like, that is white space and it will be sold into aggressively. But at the same time, I have no doubt that there are people that are doing a very good job of taking institutional management capabilities in private markets and turning that into products that individual investors could access today that they didn't have in the past. So, I mean, I personally have a lot of those interval funds, tender offer funds in my investable account, just because they're so much easier to use than having a drawdown fund. Like, that capital call when you're not a big institution that has, hundreds of millions of dollars of cash in and out, and you've got hundreds of line items where the cash flows in and out themselves sort of balance, and you can manage that process. When you get a big capital call, it seems to always be, when you got to get your HVAC repaired and your first tuition bill comes due. It's so inconvenient. And the type of institutional allocator edge sort of products that are available to now, they're managing those challenges under the hood for the individual investors.
Yeah, but Chris, you're a different type of individual investor. I mean, it- in terms of suitability, you understand those investments. I mean, and not all of them work. I get it, but there's a certain suitability, and you probably meet the threshold for accreditation.
That's also why that these products are not, which by the way, I think we chatted briefly about this. I think this is the next big frontier. These are not direct to consumer products. None of these are available at a supermarket that an individual can log on to and just buy. So these are all advisor approved products, and the advisor has the responsibility for the suitability decision for the client. They need to know their client, and they need to know that this product is suitable for them. So it's a big responsibility, and the advisor community is increasingly more sophisticated today than they were 5 years ago, and infinitely more 5 years ago than they were 5 years before that. So it's happening quickly, but I think ultimately, yes, there will be that layer that gets removed, and a lot of these products will be sold direct to consumer.
I agree with you there. I mean, the financial advisor or the intermediary provides some diligence to make sure that there's there's suitability, right? That the
Correct.
investor understands. It's kind of like we talked about. You got to sign a form for trading on margin or trading options. It'll be the same thing. But what about in my 401k?
Yeah.
Putting these in a 401k is different.
It is different. And there's a couple of different things to consider. First is that, it's a smaller market. It's 10, 12 trillion as opposed to 100 trillion. It has another layer of fiduciary, the plan sponsor. And plan sponsors are, from what I can gather, fairly concerned about the risk of putting options into the plan that might not be suitable for their participants. And so liquidity needs, et cetera. I think one area where we will not see any adoption rapidly is dedicated asset class products, i.e. pure PE. Yeah. Because that runs the risk of an uninformed participant just going, I'm going to do 100% PE. That can't happen. And so what I'm seeing is there are big platforms that are partnering with some of the fund sponsors to provide a slice of a target date fund that will have private markets exposure. Now that can be managed with a glide path, right? So it's easier to sort of rebalance. You've got generally like a CIT inside of another CIT, and then you have probably the whole liquidity sleeve. So there's like liquidity on top of liquidity that they can manage. But it's still, it's still a risk. People are not certain. However, this makes it a potential easier trade if and when it happens. There's no tax consequences inside of the 401k for rebalancing. What I experienced in the wealth channel is that adoption is slow, right? Because new money has to come in. Nobody wants to blow out of their 20-year-old, S&P 500 or active equity fund with all these embedded gains and roll it into the private equity portfolio. So I think if and when adoption in tax-exempt accounts defined contribution happens, it could happen a lot more rapidly with like trillions reallocated.
But you've talked about product structure, that there's a way to build a product that would provide exposure in a way that's going to deal with liquidity, complexity, et cetera. I'm looking at it from talking to sponsors. A lot of them are they're certainly hesitant to put this into their mix. They're worried about the safe harbor.
Yep.
They're worried about that Anderson v. Intel Supreme Court ruling. And they don't see a lot of upside in doing this. Okay, so we offer it, but I may have downside liability. But if I don't offer it, I'm a good fiduciary. So I think that's going to be one of the barriers until we straighten out the safe harbor.
Totally. There's uncertainty around that liability, and that many of them are just not interested in pursuing it. I will say there are a few. There's a big grocery chain here in Texas that has alts and private markets already in their 401k. They manage it in-house. It's called HEB. It's a pretty sophisticated team, and they've done a good job of that and managing it for years already. So there's examples of how it can be done. The other thing that might drive adoption is I saw a survey, I think it was from Plan Sponsor Magazine, where participants, like 60% of them said they would invest in private markets if there was an option available. So back to Wall Street and productization, where there's a will, there's a way. And where there is demand, there will be sales.
Yeah, I'm not sure the demand's there, but if there's opportunity to sell, they're building a hell of a lot of product
demand
right
too.
now.
I mean, it's a self-fulfilling prophecy, right?
Yeah. Yeah.
It's part of the education and it's part of the sales process.
Yeah. Well, Chris, anything else you want to cover? I'm sorry, did I cut you off? You had another idea for me? Anything else
I was just
going to
say,
there?
I mean, as an allocator myself, I think that there is a premium that can be harvested in private markets when they're done right. And I think, big public pensions have been investing and endowments and foundations for their beneficiaries have been investing in that for a long, long time. So it does seem to make sense, I think, from an asset allocation perspective, but it's got to be done right. Like, there's good product, there's bad product, like anything else.
Good product, bad product, a lot of disclosure, making sure people know what they're getting into. And
I think education is a huge part of it. And I think we're going through sort of an education cycle. If you've seen unless you've been living under a rock, you have seen what's happened in private credit, like big demand for that in retail channels the last 3-4 years. That's changed, and you've seen a lot of outflows from BDCs, from interval funds in the past 6 months, 8 months. There's still private credit in evergreen vehicles is still up year over year, but the demand has definitely slowed. I think what has happened as people realize the products didn't offer the liquidity that they thought, and whether they were missold or just not sold adequately, I think there's probably a little bit of both, but I think education has improved, or I like to think it has improved. And I think we're seeing sort of a resizing, right? If you sold your S&P 500 in April 2009 because you just couldn't take it anymore, like you probably had too much equity risk in your book to begin with. And so the correct decision is to just resize down people that had too much exposure. If you have too much illiquidity in your portfolio and you're not comfortable with it, you resize and don't take as much liquidity risk. So I think a lot of the early adopters that maybe had 10% in private credit are sizing it down to 5. Or if they were 5, they're now down to 2.5. And so I kind of think this might be a one-time cycle where people are learning, taking their sort of lumps and saying, we don't need that much. This is the right amount. And we'll come out the other side with a better appreciation for the structure of these things. They're liquidity bridging mechanisms, not liquidity transformation mechanisms.
Anything else you want to add to our conversation? Because you and I always kind of go wherever we go. We covered a lot here, different topics.
We did cover a lot. Yeah, we went where it takes us. So,
well, good. I'm good with this, Chris. I want to thank you for being on the show, and always look forward to our next conversation or what you're writing. So please keep it going, man.
I appreciate the chance to chat, and maybe we should do another ham and egg piece.
I'd love it. All right. Thanks, Chris.
Thanks, Angelo.
Against Consensus is a weekly podcast in collaboration with Fin News. In each episode, I interview asset owners, asset managers, allocators, service providers, and innovators who are challenging conventional thinking to create better investment outcomes for their beneficiaries and their clients. Our goal is to elevate the conversation and help you make better, smarter investment decisions, but always with a little edginess along the way. All opinions expressed by hosts and guests are solely their own. The information presented in this podcast is for educational and informational purposes only. The host, guests, and their affiliated organizations are not providing investment, legal, tax, or financial advice. Investment strategies discussed may not be suitable for all investors, as individual circumstances may vary.